Okay, let's unpack this. We're diving straight into the world of initial public offerings today. Specifically, we're putting JSW Cement's recent offering under the microscope. Our mission: simple, guide you through the essential insights, the updates, so you really get what's happening here and, why it might matter to you. So let's start with the big picture. What's the headline for JSW Cement, their market position, this offering?
Well, what's really striking about JSW Cement is just how fast they've become a major force in India's cement game. They've been like one of the top 3 fastest growers. We're talking grinding capacity, sales volume, fiscal 2015 right through to fiscal 2025.
Fiscal 2025, just to be clear, that's their year ending March 31st, 2025.
Exactly. And they're also in the top 10 overall for installed capacity and sales volume as of that date. And here's a really key detail. They're India's largest maker of GGBS, that's granulated blast furnace slag, super important for green cement.
Green cement, okay. And the IPO itself, dates, numbers.
Right, so the offering, it opened August 7th, closes August 11th. They're aiming to raise 3,600 crore rupees total.
Which is what, 36 billion rupees?
A huge number.
It is. And that includes a fresh issue, new shares of 1,600 crore rupees. That's the money going directly to the company. The price band is set between 139 and 147 rupees a share, 147 being the top end.
Okay, 1,600 crore coming in fresh. What's the game plan for that capital? Where's it headed?
The big chunk, that whole 1,600 crore, is specifically earmarked for a new project, a brand new integrated cement plant out in Nagaur, Rajasthan. That's a major expansion.
Integrated, meaning clinker and grinding both.
Exactly. And beyond that, they also plan to use funds to pay down some existing debt. That's pretty critical. We'll circle back to that. And, the usual general corporate expenses. But it's really important for you to know they actually reported a net loss, 163 crore rupees for fiscal 2025. Right. A net loss. That definitely catches your attention, doesn't it? Makes these expansion plans seem, well, interesting. So, okay. Beyond the IPO numbers, what's the core business? What makes JSW Cement stand out in a crowded field?
Well, as of March 31st this year, they really cemented their place, top 10 in India. Capacity, sales, they're up there. Their product mix is pretty broad. Blended cement, standard OPC, even specialized stuff like ready-mix concrete. But the real kicker, their main differentiator, is that GGBS dominance.
That eco-friendly slag product.
Precisely. They hold an incredible 84% market share there in fiscal 2025. That's not just niche. It's a massive edge, especially with the focus on sustainability these days.
84% is huge. And operationally, how many plants are we talking about?
They've got 8 plants currently, spread across India and 1 in the UAE. Total installed grinding capacity is 20.6 million tons. And clinker capacity is 6.4 million tons.
That's a decent network. How well are those plants running? What's the utilization like?
Yeah. Okay, so if you look at the overall grinding capacity use, it was around 62.89% in fiscal 2025.
63%. Seems okay, not amazing.
Well, the average maybe seems moderate, but dig deeper, and some units are just humming. Like their Vijayanagar grinding unit down south, it ran at an incredible 104.94% utilization in fiscal 24.
Whoa, over 100%. How's that work?
It means they were producing more than the nameplate capacity suggests, really pushing it, likely due to strong demand there. We also saw some strategic shifts, like the grinding capacity at Shiva Cement in the east that was dismantled after a new, more efficient clinker unit fired up last year, mid-2023.
Okay, so variable performance. What kind of manufacturing strategy underpins all this?
That's a great question. It's quite unique, actually. They call it a hybrid model. It means they mix integrated units plants that do both grinding and clinker production, like Nanjal near their limestone sources. But they also have dedicated clinker-only plants, like Shiva Cement in the east, and then several standalone grinding units.
And how does that hybrid approach help them strategically, especially with that green cement focus?
It's actually quite clever for their green strategy. A lot of their grinding units, they're deliberately co-located right next to JSW's steel plants.
Right, because of the slag.
Exactly. It makes getting that blast furnace slag, the key ingredient for GGBS and other blended cements, super cost-effective. Minimal transport. So this model directly supports using industrial byproducts, which means they get a much lower clinker-to-cement ratio. It was 50.13% in fiscal 2025. Compare that to the peer average, which is around 66.43% in fiscal 24.
Lower clinker means less CO2, more sustainable, right? And probably cheaper.
Generally, yes. It's good for the environment and often good for the bottom line, too. Efficient resource use. Now look at their market presence. As of March 31st, 2025, Over half their grinding capacity, 53.4%, is in South India, then about 22% in the West, and nearly 25% in the East.
How's the demand outlook in those regions?
South and West saw kind of modest growth in fiscal 25, but the projections look pretty healthy, 6-7% CAGR through fiscal 2030. The East is expected to be even stronger, maybe 7-8% growth. What's interesting is they have zero presence right now in the North and Central regions, but that's about to change.
So that leads right into their expansion plans. Sounds like they're making some big moves. Are they really doubling down?
Oh, absolutely. It's not just doubling down. They're aiming to nearly double their capacity. It's huge, grinding capacity. They want to boost it by over 103%, from 20.6 million tons now up to 41.85 million tons. And their clinker capacity is set to double right alongside that.
Wow, over 100% increase. That's massive.
Yeah.
Where exactly are these new plants or expansions planned?
They've got several key projects already rolling. North India is a big focus. That integrated unit in Nagaur, Rajasthan. Environmental clearance is done, land is acquired. That's huge progress.
Major hurdles cleared there then.
Definitely. Then another grinding unit planned for Talwandi Sabo in Punjab. They've applied for the environmental clearance. Over in the east, there's a proposed grinding unit at Bhushan Power and Steel in Odisha. That's expected to eventually transfer to their subsidiary, Shiva Cement. And it's not just new plants, they're doing brownfield too, expanding existing sites. Their Vijayanagar unit in Karnataka, set to add another 4 million tons annually.
Okay, brownfield and greenfield. Where are the new greenfield ones?
New standalone grinding units are slated for Dolvi in Maharashtra and Hatta in Madhya Pradesh, plus another grinding unit planned for Uttar Pradesh, though the exact spot isn't finalized yet. So yeah, taken together, it's a major investment push to build a truly national footprint.
Okay, impressive operational scale, huge growth ambitions. Let's ground this now. How have the financials actually looked recently? Let's pivot to the numbers.
Yeah, the financials tell quite a story. Net sales actually dipped slightly in fiscal 2025, down to 5,813 crore rupees. Now, the main reason was a drop in what they call cement realization per ton. Basically, they got less money for each ton sold.
Even though they sold more volume.
Correct. Sales volumes were up, but the price per ton dropped by nearly 8%. So revenue slipped. And their gross profit margins also took a hit in fiscal 2025.
Falling prices. That's tough. What about the cost side? Any major trends there?
Well, employee costs have been climbing steadily, hit 369 crore in fiscal 25. Mostly higher salaries, but also a jump in employee stock option expenses.
Okay. Any good news on costs?
Yes, actually. Power and fuel costs went down in fiscal 25. That helps. Partly due to softer fuel prices globally, but also their increased use of renewable power. Freight costs also eased slightly. However, a big flashing light is finance costs. They've just kept rising. Hit 450 crore rupees in fiscal 25.
450 crore just in finance costs. Why the jump?
It's largely down to higher interest they're paying on lease liabilities. And if you connect all this, the bottom line is the company reported a loss before tax, minus 43.6 crore rupees in fiscal 25.
A loss before tax. The big swing from previous years, wasn't it?
A very significant reversal, yeah. And their final profit after tax, the PAT, that was an even bigger loss, negative 163.77 crore rupees. It's a stark contrast to profits in prior years, driven by, those lower operating earnings and significantly bigger losses from their joint ventures and associates. Financial headwinds are definitely blowing.
A net loss really changes the conversation, doesn't it? Which brings us squarely to their debt. How big is the borrowing pile, and what does it mean for their health, especially funding all this expansion?
Yeah, this is definitely a critical piece of the puzzle. Their total borrowings, they've been climbing, reached 6,166 crore rupees in fiscal 2025. That's substantial.
Over 6,000 crore. Wow.
And the big chunk of that is floating rate debt, meaning the interest rate isn't fixed, it moves with the market. That makes them very sensitive to interest rate hikes. Like just a 1% rise in rates, that would have chopped another 62 crore rupees off their profit in fiscal 25.
Ouch. So rate hikes hurt them directly. What about net debt?
Their net debt, if you exclude convertible preference shares, also went up, stood at 4,203 crore rupees.
Okay, that's a lot of debt. How does that kind of load actually impact their business day to day?
Well, those high finance costs we mentioned, 450 crore, they eat up a big slice of cash flow. Directly hits profitability, big reason for that loss. Also, their loan agreements have strings attached, restrictive covenants.
Meaning rules they have to follow.
Exactly. They need to keep certain financial ratios in line, might need lender permission for big strategic moves. It reduces flexibility. And remember, cement is super capital intensive. Building plants costs a fortune. So those expansion plans, like Nagar, they need serious ongoing financing. Plus, there are other potential drains, contingent liabilities of about 111 crore.
Potential future obligations.
Kind of, yeah. Things that might cost the money later. And they've guaranteed loans for a joint venture huge amount, 1,369 crore rupees. And on top of that, some of their subsidiaries and JVs have racked up big losses themselves, needing ongoing support from JSW Cement.
It sounds like a complex web of financial commitments. How do they plan to manage all this debt?
Well, part of the IPO plan is to use 520 crore rupees from the fresh issue specifically to pay down debt. So that's a clear step.
Okay, using IPO funds for debt.
Right. But ultimately, getting this debt under control and getting back to profit, it really hangs on a few things. They have to execute those big expansion plans successfully. They need to get better prices, improve that cement realization, control costs, and the performance of those JVs is crucial too. Can they turn them around? On the plus side, they do have stable credit ratings. O+ stable for long-term loans. So lenders still see them as relatively solid despite the debt burden.
Okay, so putting it all together, the debt, the losses, the growth plans, the industry pressures. How does that IPO price tag 147 rupees at the top end actually stack up? Is this looking like a costly offer for someone thinking of investing?
Yeah, the valuation angle is fascinating and maybe concerning. Remember that loss. It means negative earnings per share, minus 1.16 rupees, and negative return on net worth too, minus 4.85% for fiscal 25. So what does that mean for valuation metrics? Well, the classic price to earnings ratio, the PE, it's not applicable because there are no positive earnings.
Right, you can't have a PE ratio if E is negative. How does that compare?
It's a stark difference. All their listed peers, they do have positive PE ratios. They're profitable. Now, let's look at another metric. Price to book value, PB, at 147 rupees a share with a net asset value per share around 23.85 rupees. The PB ratio comes out at roughly 6.16 times.
6 times book value. That suggests the market's pricing in a lot of future growth, right? Valuing it well above its current assets on paper.
Exactly. It implies high expectations.
And what about returns for people already in?
Yep.
The insiders, early investors?
This is really interesting for you as a potential new investor. Some selling shareholders just converted preference shares to equity. Very recently, July 24th, their average cost, somewhere between 65 and 68 rupees per share.
So if it lists at 147.
They stand to more than double their money very quickly.
Right.
And the promoters, their average cost is even lower, like 10.60 rupees per share in some cases.
Wow. Okay, so new investors at 147 are paying a significant premium compared to what recent converters and especially promoters paid.
A very substantial premium, yes. And one more thing, that net debt to operating EBITDA ratio, it was 4.7 times in fiscal 25. That's higher leverage than the average for their listed peers. So yeah, pull it all together. Currently unprofitable, priced at a big premium to recent costs, high leverage. It could definitely seem costly.
That certainly paints a cautionary picture on the valuation.
Yeah.
Which brings us to maybe the most important question. What are the key risks here? What should potential investors really be aware of?
There are several pretty significant risks to consider. First, just the valuation itself, as we discussed. If it lists at, say, an assumed 34 times EBITDA for fiscal 25, that's way higher than the peer average of around 23 times.
A premium multiple despite weaker metrics.
Exactly. You're paying a premium valuation even though the company currently has negative profits, declining operating earnings, volatile margins. CRISIL even flagged those shrinking margins due to falling cement prices.
Okay, valuation risk is number one. What else? Industry factors.
Absolutely. The Indian cement industry is fiercely competitive, and everyone's expanding aggressively. Projections show maybe 250 million tons more grinding capacity coming online between fiscal 26 and 30.
That sounds like a recipe for oversupply.
It could easily lead to oversupply, yeah. Which puts more pressure on prices. We already saw prices fall 5% in fiscal 25 due to competition. Then there's the debt risk we talked about. That high debt load, the 4.86 times net debt to operating EBITDA, it's higher than ideal. And remember, their current liabilities exceeded current assets by over 1,300 crore rupees. That's the liquidity flag.
Worries about paying near-term bills.
It raises questions about near-term financial flexibility, yes. And finally, don't forget those subsidiaries and JVs, several like Shiva Cement, Utkarsh Transport. They've racked up big losses. to the point where auditors raise material uncertainties about their going concern status.
That sounds serious. Doubts they can even continue operating.
It's a major red flag, yes. And since JSW Cement backstops them with loans and guarantees, their problems can become JSW Cement's problems, further straining finances.
Okay, so summing it all up then, we've got the growth story, the green angle, but also the losses, the high valuation, the debt, the industry pressures, the JV issues. What's the core takeaway for someone considering this deep dive?
Look, JSW Cement definitely highlights its growth story, its leadership in eco-friendly GGBS, and those ambitious expansion plans. That's the bull case. But for you as a potential investor, you have to weigh that against the negatives. The high assumed valuation, the fact they're losing money right now, those volatile margins, the very substantial debt burden, and the financial troubles bleeding through from associated companies, all happening in an intensely competitive market. It's a complex mix, isn't it? High ambition clashing with some pretty significant financial headwinds and risks.
It really is a complex picture. That was a truly thorough deep dive into the JSW Cement offering. Really fascinating how many layers there are when you start peeling back a company's financials and future plans. We really hope this has given you plenty to think about and maybe shed some light on the key things to consider here. And just a crucial reminder, we are not SEBI-registered financial advisors. Investing involves risks. If you're considering making any investment decisions based on today's discussion or anything else, please consult with a certified financial advisor first. They can help you assess your own situation and risk tolerance.